All right, let's pull back the curtain on how professional traders actually hunt for opportunities, especially when the market is this on edge. We're going to forget about gut feelings today. We're diving deep into the world of data, probabilities, and just plain old discipline. I want to start with just one number, 31.05. Now, this is the VIX reading. You can think of it as Wall Street's fear gauge. And to put that into perspective for you, anything over 30 signals extreme stress. It tells us that traders are basically bracing for some serious turbulence up ahead.
And the reason for all that fear is what some traders call exceptional tail risk. That's really just a danger of a rare but absolutely massive market move. And it's not just one thing causing it, It's this perfect storm of economic reports, geopolitical deadlines, all hitting at the same time, basically creating a minefield for anybody trying to invest.
So before a trader even thinks about looking at a specific stock, they have to understand this big picture. The first step, always, is to read the macro environment. You got to know what the weather's like before you set sail, right?
And a huge piece of this macro puzzle right now is geopolitical risk. A disruption over in the Strait of Hormuz, that could put nearly 18 million barrels of oil per day in jeopardy. And with a hard deadline of April 6 just looming, the energy markets are on a total razor's edge. And of course, that tension spills over into everything else.
On top of all that, traders have to navigate what looks like an economic gauntlet this week. It kicks off with Fed Chair Powell on Monday, and his speeches can always move markets. Then you've got oil inventory numbers on Wednesday, which ties directly back to that Hormuz situation. And the week wraps up with the big one, the jobs report on Friday. Each one of these is like a potential market explosion waiting to happen. Okay, so with this incredibly volatile big picture in mind, how does a trader even begin to sift through thousands and thousands of stocks to find an opportunity? Well, this is where the real hunt begins. One of the most powerful tools they have for this hunt is scanning for something called unusual options activity. In simple terms, this metric just flags where big, new money is suddenly flowing. It's kind of like seeing a huge flurry of bets being placed on one horse right before the race starts. Doesn't guarantee a win, of course, but it sure tells you that someone with a lot of conviction is making a big move. And I mean, just take a look at these examples. For NVIDIA, you're seeing options volume that's over 1,500 times the number of existing contracts. For Meta, it's over 1,000 times. These aren't just normal market whispers, This is the market screaming that something is happening with these specific names right now. So you've got a potential target. Your scanner has flagged a name like NVIDIA or Meta. Now the real work begins. It's time to put that stock under a magnifying glass and really analyze the specifics of the potential trade. A huge part of this analysis comes down to these option metrics that are known as the Greeks. Let's just focus on two really critical ones for short-term moves. Think of your trading position like a car. Delta is its speed. It tells you how much the options price changes when the stock moves. But gamma is its acceleration. It's how quickly that speed changes. And in a really volatile market, you want that high acceleration.
But is that it? You've got your macro view, you've got a hot stock, you check the delta and gamma, and you're good to go? Oh, not even close. What else is on a professional trader's pre-flight checklist?
The reality is, the analysis goes incredibly deep. Professional traders often use a checklist that can run over 28 factors long. They're analyzing the quality of the liquidity by looking at bid-ask spreads. They're looking for clusters of bets on certain prices, comparing a stock's strength to its entire sector. It's this rapid-fire synthesis of an immense amount of data, all before a single dollar is ever put at risk.
And all of this, it brings us to the core concept of this entire process. See, trading isn't about gazing into some crystal ball. It's about understanding and playing the probabilities. And the key to doing that is a tool called the expected move. This is the question everyone asks, right? With all this data, with all this analysis, surely you can predict where the stock's price is headed. You don't, and that's maybe the most important lesson in all of this. Certainty just doesn't exist. But what you can do is measure what the entire market collectively expects. You can actually put a number on the probable range of outcomes. And that measurement, that's the expected move. It's a statistical range that's calculated directly from options prices. And it essentially tells you that, based on all the current data, there is a 68% chance, that's one standard deviation, that the stock price is going to land somewhere inside this very specific zone by expiration. Let's make this super simple.
Imagine a stock is trading at exactly $100. The options market then calculates an expected move of, say, plus or minus $5.72. Now, this doesn't tell you if the stock is going to go up or down. What it does tell you is that there is a 68% probability it will finish somewhere between $94.28 and $105.72. That, right there, defines your playing field.
So let's bring it all together. We have a fearful market, we have a deep analytical process that's focused on probability. So what's the single most important rule to follow?
Remember this number, the VIX, sitting over 31. This is the context that hangs over every single decision. It's the big flashing red light on the dashboard, and it completely changes the objective of the game.
And this right here is the golden rule. When fear is this high, the number one goal is not to get rich, it's to survive. It's all about protecting your capital because the risk of a sudden, catastrophic move is just exceptionally high. Your focus has to shift from offense to defense.
And that's really the bottom line. The winners in a week like this, they aren't always the ones who made the most money. No, they're the ones who are still standing when all the chaos subsides, ready and positioned to capitalize on the clearer opportunities that always emerge.
Which leaves us with one final question to think about. In a game that is fundamentally about managing probabilities, not predicting certainties, is the biggest threat to your success really a bad trade? Or might it be your own inability to stick to the rules when fear and greed start to take over?